I was recently speaking at a conference and I asked the room of medical professionals this question: who here would like to earn an extra $10,000 a year that you didn't have to go see more patients or work more shifts to get? And every single hand went up in the room, right? Whether it's 10,000, 20,000, 30,000, 50,000, whatever your passive income goal is, most medical professionals like the idea of having a way to have your money earn more money without you having to work more. I'm going to cover in this video the top 3 ways medical professionals can actually generate passive income. Now, I don't believe in gimmicks, so we're going to go through the good, bad, the ugly of each one and talk about what passive income versus semi-passive income is. But regardless, take some notes because this is going to be the stuff that allows you to increase your income without increasing your hours. Option is investing in the stock market, and it's easy because it requires almost no barrier to entry, right? You can go open a brokerage account, a Roth IRA with any of these major custodians like Fidelity, Charles Schwab, Vanguard. You'll have no account fees. You can take $20 and go buy an ETF, right? The barrier to entry doesn't exist. And then you receive dividends. Now, dividends, if you're not familiar, are basically a company taking a portion of its profit and giving it to you, the shareholder, as a distribution. Now, not all companies pay dividends, right? Just because a company, their stock doesn't pay a dividend doesn't mean they're a bad investment. Maybe they're reinvesting all of their profits and they're not issuing them in the form of dividends to shareholders. Also, just because a company is not publicly traded doesn't mean it's a bad investment. That's a whole other thing. But this is a very easy way for someone to use the stock market to achieve, quote, passive income. You can see the S&P 500 dividend yield history here, and it's varied over time. But again, the S&P 500 is built up of a lot of stocks that are known for paying dividends. It's not a fund structured specifically for investors looking for high dividends, but you'll get a dividend yield just by investing in the S&P 500. The question is, how much money invested in the stock market do you need to start generating a decent amount of dividends, right? So I'm going to go through each of these modalities in the terms of what does it take to generate $50,000 a year in passive income using each of these modalities. So if you assume a 5% dividend yield, you would need $1 million invested in the stock market to get that $50,000 a year in passive income. Now remember, dividends are true passive income, right? Like once you make the initial purchase, you do absolutely nothing else. No work, zero work. However, $1 million in capital to get there is a pretty hefty price to pay, right? And so that's one of the downsides of using this modality for passive income. Now, these aren't personal recommendations, but if you're looking for funds that specifically invest in companies that are known for higher dividends, those exist, right? Here's examples at Schwab, Fidelity, and Vanguard, all great custodians. Now, most dividends are technically taxed at your ordinary income rates. However, qualified dividends are actually tax favorable and they're taxed at lower long-term capital gains rates, which is lovely, right? Now, most of the big funds you've probably heard of, these are all examples of Vanguard funds, like an S&P 500 fund at Vanguard, an all U.S. stock index fund, etc. You can actually find the number of what percent of their dividends is qualified, and you can see that in this example, it's very, very high, right? Most of these dividends are actually taxed at these lower capital gains rates, which means totally passive and actually pretty tax advantaged. So the downside is that it takes a long time to get there. It reduces your long-term returns, which we'll talk about in a sec, but it's super passive. And again, it has that tax benefit for any qualified dividend. So what does it look like to your long-term returns? Well, how is that a downside? Well, here's an example. If you look at historical S&P 500 returns with dividends reinvested, meaning you have your account set to when you get the dividend payout, you automatically go and buy more of the original security. The dividend automatically reinvests. Your returns exceed 10%. If you decide to cash out those dividends, then the return is 6%, which kind of sucks, but you can see visually here, if you look at these returns of the S&P 500, in this graph, the green is actually price appreciation, the increase in share price itself. The gold is the dividend, which makes up a huge piece of the total return. So you can really easily see how, okay, if I'm living off all my dividends, my total returns are going to be quite a bit lower. So let's say you're starting at 30, you want to hit $4 million at 65, you've got 35 years to do it. Why 4 million? Let's say you're a 6-figure earning medical professional and you want to create an inflation-adjusted standard retirement. Okay, that would be pretty average for that. You have to invest about $22,000 a year to do it, assuming a conservative rate of return of 8% compounded annually. If you decide to live off those dividends, your returns are reduced, right? We already show that a huge chunk of the total return is a dividend. And so now you actually would have to invest $40,000 a year to achieve the same goal in the same time horizon, which seems kind of counterintuitive because the whole purpose of this is to have passive income, and now you're having to invest more just to overcome the passive income that you're taking out. And so for most folks, living off of dividends is not a move you should make when you're in the wealth building phase. Once you've hit certain metrics where you have built a big portfolio, you're in semi-retirement, you might be able to position yourself to live off of those dividends and still be able to have the portfolio you need in the long term, even with slower growth. But if you're at the beginning of the wealth building journey, this can really derail you. So keep that in mind as you hear about dividends as a source of passive income. It matters what season of the process you're in. And even if you're listening to this and you're like, what the heck? I thought it was going to be great and I'm going to have to invest more and I'm frustrated. Well, it's still better than saving money, yeah? Nobody ever became a millionaire with a savings account. So you have to invest. You might as well understand dividends, how they function, and when it's a good time to use them to generate passive income. The next modality is cash flow in real estate. And this one is really kind of interesting because there's a lot of different ways you can go about it. You can do long-term rentals, you can do short-term rentals. Within long-term rentals, you can do single family, small multifamily, etc., right? There's all sorts of options. There's a lot of upsides. The primary upside is that you get this full rate of return, right? You get mortgage principal pay down, you get property appreciation, you get tax savings if you're structuring this in specific ways, and you get cash flow, right? And you get cash flow now. As soon as you have a tenant in the property and the gross revenue from the tenant exceeds all of your expenses, you have immediate cash flow. That's one of the big benefits of real estate investing. Now, the cons are that this tends to be less passive. It varies. If you self-manage, it's going to be less passive, right? You can hire a property manager, no problem, but they have a fee. So that will reduce your cash flow subsequently. One of the big cons, and this is one of the most common mistakes I see with new medical professionals trying to invest in real estate, is they haven't done the work of learning how to create accurate cash flow projections. So they buy properties with kind of blinders on, they don't cash flow, and they're in a tough spot. Now, the next one is kind of a pro and a con. It's a leveraged asset, which means you need less skin in the game to generate the result, which is exciting. But it also increases your own financial risk, because if you sign up for an additional mortgage for a property that subsequently doesn't cash flow, of course you can try to sell it, but you're on the hook for the mortgage until it sells. And so if you have $5,000 to your name and you've got your own mortgage on your primary residence, you can pretty quickly put yourself in a bad spot. Now, the last con is liability, and of course, there's a whole field of asset protection attorneys out there waiting to help you mitigate your liability. So that's a solvable problem, but it's something to think about. Now, this is an example, again, of what it actually looks like to generate cash flow. This is a real potential property where I'm from in Indiana. The purchase price is listed here at $205,000. You can see the projected rental income, projected expenses, and it's projected with 20% down and total cash to close of $45,000, creating monthly cash flow of $231 a month, which is pretty common for a single door long-term rental, right? Now, note, this does not have PM fees built in. And so PM fees will vary, property management fees will vary. For long-term rentals, you may find something in the 8 to 10% range. The fewer doors you have, the more it tends to be. And so you might go, okay, $200 a month isn't that great, but remember, you also get those other three modalities of return. You're also having a tenant pay down your mortgage. You're also getting property appreciation. You're also getting tax savings. So it's not just the cash flow, it's the rest of the pieces too. So then what does it take to generate that $50,000 in annual passive income? Probably semi-passive for this, right? $810,000 in the game for you. So less than using dividends, right? Because it's a leveraged asset is what it comes down to, but still a hefty chunk of change. And so maybe your goal is, I'm going to generate $10,000 of passive income, and you work your way up. Regardless, this is a very easy path towards generating a cash flowing investment. If you choose to use short-term rentals, these numbers look a lot different. We don't have time to get into all of it, but I'll preface with that. Long-term rentals, in theory, are more stable, have lower cash flow, less work, right? And the cost to get in is probably less. Short-term rentals have variable income often, like seasonality. For example, one of our short-term rentals has 2 months out of the year, 0 bookings ever, right? There's tremendous seasonality in that market. So you have to plan for that. But the cash-on-cash return should be higher with a short-term rental, which means you may have less skin in the game to generate that same $50,000 a year. Now, this could be seen as a pro or con, but you're in the hospitality business, right? So when someone sends you a message at 2 a.m. saying, hey, Kristen, we actually went through 17 rolls of toilet paper in the last 12 hours and we want more, even though we said we only had a party of 5, you have to find a reasonable way to respond to that, okay? So again, this is just the nature of owning a short-term rental. Also, the markets, not always, but may be more expensive, depending on if you're in some of these prime vacation markets where properties have really blown up in value. Now, the last one I'm going to talk about is syndications, specifically private equity syndications into real estate. Now, this is really passive, which is great. True mailbox money, so to speak. It doesn't come to your mail anymore, right? This is 2025. It comes to your inbox and says, hey, you're going to get a direct deposit. But regardless, it's mailbox money. And it's really nice in that way. But there are downsides we're going to talk about. So this is a partnership between a group of people buying something very large. This is not buying like a $2 million property. This is buying a $25 million apartment complex, etc. Right? Something that is very difficult for an individual investor outside of certain people in the United States, not us, to buy on their own. And so there's a structure of general partners who tend to be the people who actually manage the ins and outs of the project. And then there's the LPs, limited partners, which are you and I, the investors, right? The returns can be high, or you can lose your butt, okay? So this is an example of a potential return setup for a syndication. You invest $100K. It's written on the slide like that intentionally because most syndications have a buy-in of $50 to $100K minimum. This is not something you can typically invest in with a smaller piece than that. You might get 8 to 10% in annual cash flow. Okay, it's illiquid, meaning there'll be a period of time where you cannot access your money for any reason. For ours, for example, it's 5 years. And so after the 5 years, then you can withdraw your initial investment. You can expect a certain return on that, right? And so when you combine those returns, in theory, the numbers can look pretty darn good for these. Now, again, in theory, because these tend to be the type of investment where if the property doesn't perform as expected, you have no recourse. You just lose your money. That's it. That's that, right? These are not guaranteed. You should have an attorney look over any contract before you sign it, but this is not guaranteed. When our attorney looked over ours, they said, hey, look, you're not going to be able to force any distribution. So this is a higher risk investment with potentially higher reward. Most of these, not all, require you to be an accredited investor. So per the SEC, that's a net worth over $1 million, not counting personal residence, or there's an income rule, 200K if it's just you, 300K if it's you and a spouse. It's had to have been like that for a few years and going to continue in the future. And if you meet those criteria, you can have any CPA or attorney tell you, hey, you're an accredited investor, get you a certified letter. Now, this is a barrier to entry, right? Like at the beginning, we talked about investing in the stock market and getting dividends. The barrier to entry was like $0. You could have $20 and do it. The barrier to entry over here is way different, right? We're talking about $50,000 to $100,000, and for most, not all, accredited investor status, which means you got to be a little bit further down the line financially to hit that mark. The tricky part is you have to really know how to do due diligence with these. You have to be able to evaluate the sponsor, the operators, the market, and the deal. And if you don't know how to analyze a single family long-term rental, it's not very likely that you're going to be able to analyze a deal on a massive apartment complex very well. And so this can be a tricky type of investment for a medical professional to make who doesn't have a lot of knowledge on the topic. The pros, true mailbox money, right? 1,000% passive. Cons, extensive due diligence is mandatory. Again, you can just lose all of your investment pretty easily. And there's that accredited investor requirement that's common for these types of investments, not always. Keep in mind there's something called a capital call, and they actually can tell you, hey, look, we're running out of money. We need more money from you, investor, and you're contractually obligated to give us the 25K or whatever that we're asking for in the terms of capital call. So that's another con for this structure of investment. But this is the obvious pro, right? Once you do the due diligence, once you sign over your money, you do nothing. You get distributions on a monthly or quarterly basis. They show up. Hopefully you reinvest them if you're a boss, right? And then that's it. Like, you don't have to do anything else. There's no calls about toilets. That part's really, really nice. Keep in mind, there are a million ways to generate cash flowing investments outside of what we just talked about. Truly a million. If what you're after is cash flow, you just have to think about what type of investment modality is going to be in line with your skill sets and with not only cash flow now, but also net worth growth in the long term. So many different ways to do this. The key is to shift your mindset from being a consumer to becoming a true investor and thinking about, how do I allocate my earned income into things that will earn me more income rather than things like a car, a new primary residence, whatever the next vacation. Not that any of those things are bad, but it doesn't get you ever off of that hedonic treadmill. You just have to work more for your lifestyle, work more for the lifestyle. If you consistently allocate a portion of income into building true cash flowing assets, you do eventually see a transition point where you start to earn more outside of work than you do at work, which is financial independence, right? When you have cash flowing assets that actually take care of your entire lifestyle rather than your job.